Go for it, Hardik.
Thank you.
So I'll kick off with an introduction to you. So good afternoon, everybody. Good afternoon and welcome to our Little Champs webinar with the chairman of Suprajit Engineering, Mr. Ajith Rai. Ajith ji, welcome to the webinar.
Thank you.
I'll broadly lay out the sequence of events so that everybody knows how the next 1.5 hours will play out. So I'll introduce Ajith ji and give you a sense of his stellar career. Then I'll hand over to my colleague Ashwin Shetty. He will moderate a discussion with Ajith Kumar Rai for the first half an hour. From the 5:30 p.m. mark onwards, we will start taking your questions. So feel free to fire in as many questions as you have using the Q&A box. Don't use the chat box. Put the questions in the Q&A box. We have Ajith ji till 6 p.m. We'll ask him as many of your questions as possible till 6 p.m. From 6 through to 6:15, 6:20, Ashwin will give you an update on Little Champs. And you can ask him questions on Little Champs. 6:30 p.m. we will bring proceedings to a close today. So without further ado, let me give you a sense of Ajith Kumar Rai's background. Ajith ji studied engineering at the National Institute of Engineering and the University of Mysore. He did his bachelor's in mechanical engineering from the NIE in Mysore. Then he went off to Canada. He did his master's in industrial engineering from Dalhousie University in Halifax, Nova Scotia in Canada. After completing his master's, Ajith ji did something which was quite remarkable in those days. He returned to India to set up Suprajit Engineering. He is the first generation promoter. Remarkable. In the mid-80s, for people to come back from the West to set up a business in India was rare. We thankfully did that because in 1985, Suprajit was born. Suprajit Engineering was born. Today, as many of you know, Suprajit Engineering is a top 500 listed company in India. The company has grown both through rapid organic growth, plus it has made 6 acquisitions in India, in US, in Europe over the last 20 years. In fact, if you ask me, over the last decade or so, amongst Indian promoters we have met, Ajith Rai rates very highly as a high quality capital allocator, courtesy the stellar acquisitions he's made. This is a very rare skill. You'll very rarely see Indian promoters making good acquisitions, and Ajith Rai is a great exception. As you can now make out with his qualifications in America, with his nearly 30 years of running Suprajit, he's built a formidable body of experience. He is a member of the American Institute of Industrial Engineers, of CII. He's an active Rotarian, and we should also add he's actually also a very good investor. In fact, spending time with Ajith Rai, we learn as much about investing as we learn about engineering. So without further ado, I'll hand it over to Ashwin for him to host the Q&A with Ajith Rai ji. Thank you.
Yeah, thanks, Saurabh. Once again, welcome, Mr. Rai. I think our investors will really have a very insightful session learning from you. How about your experience of building Suprajit from scratch, and more than 3 decades of experience in the auto ancillary field. So, sir, we will on the initial session we will cover what are the key questions over the course of last 3 years of covering this space about the succession, especially in the small cap space that we encounter. So, sir, first question is regarding the delegation, because typically in the small cap space, the promoter has built the company, through its journey. So, wanted to understand with you, what should be the thought process about delegation? First of all, is there any actually should the delegation happen? And if yes, sir, what should be the trigger point? What is the trigger point when you realize that you need to delegate? And thirdly, within that same question, how to go about it, sir? So, like basically, first is why, second is when, and third is how. So we can kick off with this.
Good afternoon, everybody. And first of all, let me thank Saurabh and Ashwin for giving me an opportunity to talk to all of you. I'm a somewhat reluctant speaker, but somehow Saurabh and Ashwin pushed me to do this. So here I am. Succession planning is something that has been close to my heart. In fact, something that we have done quite a bit of work within our family and in our business. If I'm able to share some of that with all of you, and I'm able to answer some of your questions, I think it will be equally beneficial to me to understand the kind of challenges some of you are probably facing. I think, Ashwin, first and foremost, I think what you are asking, the first question is more on key man risk, really speaking. Most small, medium enterprises have this key man risk because it is the promoter who is responsible for most actions. I think there is even a lot of insurance companies make money out of key man risk cover. But I challenge myself saying that why should I be a key man and be a risk to the company? I think it was very important for me, I'm talking about 15 years ago, to see when I was still not even 50, that how do I de-risk my business and future business of the company. I think that was the main thing. The biggest challenge, I think, we as entrepreneurs, as promoters feel or have a concern is about letting go. I think the biggest challenge first generation entrepreneurs have is their ability to let go. There is a multiple concerns on letting go of what one is doing. It all gets, unfortunately added to that becomes an ego. There's nobody else who can do a better job than me. 20 years ago, I was everything. Maybe 25 years ago, I was everything. I was a purchase manager, I was a finance manager, I was a production manager, I was marketing manager. You must understand that when the company grows beyond certain level, where you are not able to give the right time, it is not that you cannot do a job of all of these, but then as you grow in size, I think it is important to understand that there can be a better purchase manager, there can be a better finance manager, there can be a better marketing manager than you are. Because if you are a first generation who has started, yours is all tribal knowledge. There are other professionals who have learned, understood in multiple scenarios as to how to deal with whatever the business scenario, whether it is operations, management, or purchase, any department, better than you have done. So the biggest concern is one of letting go, I think. And then added to that, there is an insecurity. There is a feeling that I am irreplaceable. These are all the concerns of promoters, which holds them back from letting go, in the process professionalizing the organization. There is also fear of unknown. Okay, if I let go tomorrow, my CEO is there, what am I going to do? What is my job? I think it can be easily answered. I'm sure there would be some questions, so I'll answer that, at a later time. But I think these concerns, most of it is basically a myth. If somebody thinks that my job cannot be done by somebody else as well, if not better, in most cases, I'm not talking about some highly technical, highly scientific research areas where the key man is the key, inventor. Maybe that part of the thing may be irreplaceable, but most of the business, I think 95% of the, I'm sure the people who are listening to this, their businesses are not something that is rocket science, I would say. So if it is not a rocket science, I think there's somebody else who can do. In the process, you will have more time for yourself to do a long-term planning. I think we as promoters, what we need to do is what this company or your business should be in 3, 5, 10, 20 years. Not what's going to happen today, tomorrow, which is what you're currently bogged down with. And you have no time to think about anything else. So it is important to first understand somebody can do your job. What you need to do for that is simply that you have to have a system in place. You have to have key performance indicators for whoever the new person coming in. You have to give him targets, budgets. You have to have a proper review mechanism. Yes, there is a concern that whether the new guy understands the job, is able to do the job. It's all very fair concerns. I also had the concern when my first president and CEO joined me some 15, 16 years ago. But then I said that no, I need to let him have the playground, tell him what the boundaries of his playground, review his performance every quarter, every month, every week, whatever time that you think you need to do. But give him that freedom, the independence, with the clarity that this is what is expected of. As long as you do that and don't do a backseat driving, because Many times what happens in promoter-driven companies that, all your next levels, reportees now starts reporting to the new CEO. And they're probably not happy. They will come back to you and tell you, sir, that is not right. This is not right. Don't get involved. You do your reviews, yes. But if you have people who are coming back and wanting to continue to report, I think it's important to let them understand that there is a new boss in town and you have given him the authority and responsibility to do the job. I think these are some of the points that I think I would say. And it is possible to find good business managers. Many a times it's felt that small businesses cannot hire talent. As long as you are willing to give him responsibility, as long as you are willing to give him freedom of operations. Professionals enjoy working with promoters and entrepreneurs. All the three CEOs that joined Suprajit at the group level, at reporting to my level, have all been professionals working in MNCs, and they haven't had any problem to report to me or continue to run this company better. So I would say that some of the thoughts at this moment.
Okay, great, sir. And sir, just a follow-up to that point. So you alluded to it, but what should be the role once the executive team is well laid out and built? What should be the role of the founders or the promoters?
I mean, I would think that some of the areas where promoters should always be involved is formulating the vision of the company. Most of the we're a public company. So let's say my CEO has got a 3-year time frame. He will be interested in maximizing what he can do in 3 years. His performance is going to be decided by his 3 years. But I think we as promoters look beyond 3 years. We look beyond 5 years. I'm looking at what Suprajit should be in the next 10 years. If I set up a STC, the products are not for tomorrow. It is probably much later. So it's important that we need to set those long-term vision and plans. And I think capital allocation is an important part. I think, I take it very seriously. What is the capital allocation that needs to be done year on year? The budgets, monthly reviews, expectations of targets to be met. All those areas needs to be reviewed very clearly. It is not that you let go and go home. No, I think a proper mechanism of review is very essential. That to particularly companies like us where we have multi-geographical operations, where we have very clear weekly reviews and monthly budget reviews, etc., etc. They're all very important to make sure that the executive team is working on the plan that has been laid out and those plans are being executed as per the budget. So that we get early warning signals if something is going wrong. I don't really get involved in what's happening today at any of the plants, but I'm certainly involved what happens every week through our CEO and CXOs, what's happening in various units. I think that's the way at least we control how we operate.
Okay. And sir, moving to the next issue is on complication in the family-owned and family-run business is the interplay between the professional team members and the family members. Sir, your thoughts on this? How do you balance these two aspects?
The first advice I would say, I don't know whether I'm really qualified to give an advice. The first advice I would give is don't parachute your son and daughter who is just out of the university in the US into a CEO or a CXO position. I think it would be the first mistake. Please understand our companies are built by people. And I think the team is important. Team's understanding and buy-in is very critical in a success of any enterprise. So it's very important that nothing wrong, of course, the succession planning, part of it is the next gen to take over at an appropriate time. So the best way I would think is that if the next gen is joining, he should not report to you as a father or a mother or whoever is the current promoter. I think they have to report to the next in class who is reporting to you so that the reportability is not to you. The reason is simple. The people who are reporting to you probably have been with you for a long time and they value the company, they value you, they respect you. And they also know for all that matters at some point the next generation will come into picture. But if you're put on top of their head, they feel that, look, he's a kid who has just come back and, what does he know? But if you put him under them, they all know eventually they may be their bosses. but they will respect that, and they will try to certainly give the funda of the business to the next generation. So getting them to get to know the business, I think a good degree is necessary. I'm not saying anything about it, but I think it's only to enter the business, not to progress in the business, and certainly not to become a CXO overnight. I think they have to learn the ropes of the business. And then I think if you're able to take some of your key people to guide them, mentor them, train them, and review with them as to what you're doing. You also should review with your children as to what they are doing. But if the next level also does that very critically, the mentoring can be internal, mentoring can be, that's a very important part of grooming the children, I think, for the business. It is okay to fast track them because obviously they have to take on more and more responsibilities. But it is important that they take and do projects and be successful in certain departments which is critical for the company, whatever the departments are. And they put in the work that a normal manager and executive does, so that he understands the ropes of the business, which is very important. I think they should know the business firsthand, not just sitting in a, in an ivory tower or in a corner room. I think that should not be the way. And that's the way I have looked at in my succession plan.
Yes. And the third aspect, sir, is regarding, because we have seen in history, many of the good businesses, they fail because of, some issue in the promoter family, So how, and Suprajit, sir, how have you kind of, built that insulation of the company from, whatever developments or happenings, that may happen at the family level?
Yeah, I know. One of the reasons why, Suprajit, this is a public knowledge. We have an approved trust. We have a family constitution. We have a family business board. We have done this over the last, I would say, 7, 8, 9 years time of involving all the family members, etc., and some good advisors in the process as to how the succession planning should be done for now and for future generations. Now, one of the things that has sort of triggered me to think of this was what happened, what happened, the Ambani saga is well known. In early 2000, when Senior Ambani passed away, he passed away intestate, and the rest is all known to all of you. And I said that, look, one of the important things as business owners we have to do, we have a responsibility to ourselves, our families, and our shareholders. I mean, in our case, we happen to be a public company, so there is a larger responsibility for the stakeholders as well, that we should not leave a big void when we are not there, whether for whatever reason. I mean, you never know what happens to anybody. So we have a family constitution in place, which is, it's a very private document, but it has a very clarity as to how we want to go about. In terms of, I mean, it need not be so complex. You can just have a simple family charter. You can have a simple will. I mean, today, let me ask a question to all the participants. I mean, I don't know how many of you have really written your will. I mean, at least your children or your next generation should know what was in my father or on my mother's mind. At least they know. If they don't have it, I mean, then it leads to huge complexity in the future. I can tell you in this forum that I wrote my first will when I was in my 40s. So somebody would say, am I going to be not there tomorrow? It is not the question of that. I think it's a question of being responsible, I think. Coming to the point, I think family issues have to be dealt at the family. I think there can be a body which connects the family with the business, which could be the key executives who are working with the business. I think the interaction should not go beyond that. And I think the executive management, the professional managers, don't really mind who ultimately is the owner, but they want a clarity. I think they want to know, okay, after the chairman is not there, who is going to be the next key, let's say, decision maker? They want to know how the business will be run. As long as they get the clarity and the team is taken into confidence, I think they are fine, whatever happens in the family. And they want to have their space to operate independently and responsibly. As long as you give that, and as long as the family related issues are not ongoing and spilling out into the public domain, as long as it is internal, as long as the executive management is sort of ring fenced from that in terms of their operational responsibility, I think they are fine with it. Once you give a long-term plan that, okay, in 10 years time or 5 years time, this is how I'm growing my son or daughter, and that's what is going to eventually how it's going to be run, they are fine with it. They will work with it, and they will develop their own rapport with the next generation as well. And most important, I think the most important point that I would like to make is, what is good for the company is good for me. I think let us understand this. Ultimately, I may be a professional manager in Suprajit, but I am also a shareholder. So what is good for the shareholder is good for me also. Ultimately, as a shareholder, I want to maximize my returns. And it's the same objective of any small shareholder. So it's no different. So I think that these are the kind of things that owners should think, because an internal fight which gets into a road will destroy value eventually. And you have seen it happening in multiple places.
Okay. And sir, Suprajit interestingly owns most of the promoter shares to family trust. If you can help us, dwell deeper into that, how, what is the objective behind that, how kind of this addresses the issues, which we raised.
Yeah, I will give a brief on this. I mean, I won't go into the details. Sure. What I have felt after discussing with one, these decisions were not taken by me independently. I involved all my 3 kids and my wife in taking a call as to what we have done. The basic decision that we made was that the next generation individually will not own Suprajit. Collectively, through the trust, they will own Suprajit. That means any decision on Suprajit will have to be taken basically collectively. I mean, there are so many ifs and buts, but generally what it is. So what they will get out of the trust is an income out of the trust. They are entitled for an income, but they are not entitled to the ownership. So in the process, for generations to come, I'm hoping that the generations of our next generation run the business. They will run the business professionally because nobody owns. The best interest is to get the best results for the company, which will give them the best returns to the trust. And in turn, they will get the best income from the trust. So that's how the equation works. So, we took the permission from SEBI and transferred most of our shares to a trust. And at some time in my lifetime, or even after my lifetime, it becomes irrevocable. There is a trust, there is a family constitution as to how it should be run. There is a family business board which directs it in a particular way. So that's how it will be run for the generations to come. The descendants will get income on 2-3 ways. I mean, if you're working in the company, you'll get they will get an income from the remuneration that they receive. If they're working outside also, they will get their own. There is no bar from them working. In fact, not all the 3 sons of mine work in the company. And they will also, I've also, gifted them. These are all in the public domain, what I'm talking about. We also gifted them some shares before we moved into the trust. They will also get a dividend out of it. That means the better the company does, higher is their income. So the third one is from the trust, they will also get some income. So they will have 3 sources of income, which I'm pretty sure will make their life comfortable. At the same time, the focus would be that we must make the company work better and, do well going forward. That's how we have, sort of formulated the way we are operating.
Okay, very interesting, sir. And sir, coming to the last part before we open up the Q&A is regarding the role of the independent directors. I think an independent director is something, which is, I would say, largely ignored in a small company. But in Suprajit, we find a very pleasant departure. So, sir, your thought process about the role of the independent directors and particularly the interplay between, say, the promoters, the executive management, and the independent board directors.
Well, I think, in our board, as we were growing and, we were involved, as you all know, we are also listed. So we are also doing acquisitions. So we wanted specialists who knew the areas well. For example, we have a UK-based independent director whose expertise till he retired was all mergers, acquisitions, and global business management. He operated another publicly traded company. I ran another publicly traded company. So he gave us what's sitting in India again. We know certain things about overseas business, but we don't know as well as people who have actually done in those geographies themselves. So his expertise was on that. We have another board member who's a hardcore automotive guy who has been in automotive, was the managing director of a global MNC. So he brings that automotive perspective. We have got a investment banker who has great knowledge of investment banking, markets per se. That gives another perspective to us. We have another independent banker, an ex-banker of repute. So he brings another perspective. She brings another perspective. We have another ex-partner of a large advisory who again gives an overall perspective of many things. So the idea is to seek their guidance and pick their brains whenever we have a larger issues where we think we don't have all the wherewithal to take a call. So that helps us in those things. They become a very good sounding board whenever we discuss our strategies, whenever we discuss our plans. They bring a different perspective to us as to why have you thought of this or have you thought of that? It's an outsider's view, which is very important. Again, it's like we are like a well with all the frogs or all the fishes, but we don't know what we don't know. I'm not saying, taking a very elementary way. They give a different perspective, which helps us in a great way. They can be mentors, whether it is for our CEOs or next gen also, if needed, as needed, when needed. They bring in governance standards and check and bounce on the company's operations. They take the interest of the stakeholders. They just don't think of what Ajith Rai's interest is. I think they also certainly look at what overall the stakeholders, not necessarily the shareholder, but an overall perspective of stakeholders. And of course, a lot of reviews on the compliance. One of the biggest challenge of public companies today is on compliances, and life is made more and more difficult to us as the time goes. So we need to follow that. And they all would have been sitting on multiple boards of public companies. There is a new SEBI guidelines. Have you known about this or any new ROC thing or whatever? When there's so many of them happening. So that also helps us. They also, approve things regarding the strategies or capital allocations or, budget plans, etc., etc. But coming to the promoters and executive board members of the management team, I would say, I'm not sure, but I seem to have read many times that promoter-driven companies in the long term perform somewhat better than purely professionally managed, highly, diversified, diluted shareholding kind of companies. I would say the reason for that is probably, I don't know whether it is a true statement, but probably is because we take a truly long-term view on what's good for the company. In an earlier instance, I can say that the CEO, as I mentioned earlier, he will take a 3-year view how to maximize, again, no dispersions, aspersions on them. They'll say, what is going to be my ESOP end of 3 year and what I need to do for 3 years. He's not bothered about, I'm not saying all of them are like that. I would say that there will be certainly people who would look at what's in it for 3 years or 2 years. My term is left only for 2 years. I'm interested in maximizing. Whereas Ajith Rai looks at what's the next 10 year or 15 year or 20 years in store, where the direction should be. I think that's very important in terms of strategically positioning the company for the long term. Things like capital allocation, I mentioned already, is a very essential part, which I personally am give a lot of importance, because return on capital allocation is very important. Budgets are very important, whether it is an annual budget or a rolling 2-3 years budget. But you please understand, this all has to be done not by you and directed and handed over to your executive management. That is the wrong thing to do. I think all these are formulated together. Whereas you can put your view that, look, I'm looking at not 3 years, I'm looking at 10 years, and this is what I think is important from a 10 years point of view. If you think it is not good for the 10-year point of view, let us discuss that. That's fair enough. But I won't really say that, 1 year performance is, or 1 quarter. And unfortunately, we are a public company, and people like Ashwin keeps asking me why this quarter margin was less, or why that another next quarter margin is more, which is very difficult to answer for us many a times, because we don't look at, I mean, we do look at it. It's not that we don't look at it. So I think those long-term targets are essential for the promoter to be involved. Setting standards and discipline, I think in the organization today, I am very proud that Suprajit has set certain standards and disciplines, because it starts from me. If today I'm sitting in front of you with my blue uniform, that's why I come every day in the same uniform. I'm here at 7:30, not at 8 when everybody else comes. I mean, that sets, I'm not saying that whether I come at 10 o'clock, will the earth shatter? No, it won't. But if I'm in the office, I'm at the time. That's my discipline. And for everybody to see, doesn't change to anybody else. So these kind of things are very important to set some kind of, your footprint in the team, which helps in management team also to understand, how to work. So the interaction between executive management and the promoters are a teamwork. We need to work together to set it. And of course, board vets it, and, as I said, on various matters, they will give their view.
And just one last follow-up question on that point of independent directors. Most of the smaller companies, and even some of the portfolio stocks which we have, they say that we are not able to attract good directors with good credentials because of our size, etc. So, sir, what is your take on that?
I think it's actually a very true statement. What's happened, unfortunately, as I said, I was talking about the compliances and requirements of the bodies which govern us. Unfortunately, some of the things that has happened in the past has made a lot of independent directors wary of joining public boards, because whether we like it or not, independent board members come once a quarter, and of course, if you're interacting with them, they give the advice, but they're not responsible for the failure or success of the promoters. They only give their views, and that's about it. So if they're made to pay for such misdeeds of somebody else in the organization, they feel very threatened that why should I become a director? So that it's a very valid question. But again, it all depends upon how good your company is perceived in the market. If your company is perceived as a professional, good company, who has got governance in place, whose account keeping is good, who has, let's say, market reputation as being fair and straight and doing a good job, I think independent directors are willing to join. I think we haven't had any problem to request independent directors to join, and maybe we had to do some amount of work, but to say not available may not be correct, but it is a challenge, I agree. Particularly companies whose, let us say, financial performances are somewhat shaky. A lot of people don't want to take a chance of joining, which we haven't had that problem.
Okay, thanks. Over to you, Saurabh.
Thanks, Ashwin. So folks, keep punching in your questions into the Q&A box. From now till 6 p.m., we'll take your questions and pose them to Ajith Rai ji. Before we do that, a double disclaimer. In several Marcellus portfolios, we own Suprajit Engineering, the company of which Ajith Rai ji is the chairman. My family, Ashwin's family, Ashwin, we are all investors in those Marcellus portfolios, and therefore, by dint of our investments in Marcellus's portfolios, we are direct beneficiaries of directly interested parties in Suprajit Engineering shares. So please don't view this webinar as an endorsement of Suprajit shares. We are shareholders in Suprajit, and hence we are doing the webinar. If you are interested in investing in Suprajit, please do your own research, do your own fact finding before you make a investment decision. So with that disclaimer out of the way, Ajith Rai ji, very interesting question from Shovan Ganguly. So I'll give some pretext. I think what he's trying to figure out is, you said that one of the promoter's jobs is capital allocation, right? So the promoter's job is capital allocation. The day-to-day operations are being run by the executive management. Now, R&D and new product development, right? They're sort of, in a gray area. R&D and new product development is sort of partly capital allocation, partly operational management. So the head of R&D, the head of new product development, who should he report to? Should he report to the CEO or should he report to the promoter? Asks Shovan Ganguly.
I believe personally that there should be one man running the show. However complex the organization is, the managing director and CEO is the key man, which I am not today, actually. So I would think that he should report to him only. But please understand, the promoter is behind every major capital allocation decision, at least in our company as it is. I'll give a parallel example. We have a Suprajit Technology Center, which is headed by my second son. He reports to Mohan, who is our managing director. His budget comes to us for an approval. It first goes to Mohan, and then it comes to our collective approval. So how much capital is allocated to R&D, new product development, product or process development, things like that, is decided by what we think is the commercial expected return on those investments. We are not a pure research like a R&D center in a university. We are looking at product development which has got material impact on the future profitable growth of the company, period. So that means if they come up with a dozen products and give us, let us say, X crores of investments to develop those products in the next 2-3 years, our first question is what is the market size of this product? Second question is, who is the competition for this product currently in the market? If it is a totally new product, is it possible to break through with the customer for that product? What could be the potential business out of it? I mean, I'm talking about some of the questions. There are a lot more questions probably asked. So then we decide whether, okay, if he has given 10 products, we'll say, no, I don't think we can work on 10 products because these 2-3 products are not really going to give me the results that we want, or the size is appropriate, or customer may not accept, whatever our best judgments. We're willing to, discuss with another technology guy to see whether this product is really possible to be commercialized. And then decide, okay, these 5 products will agree. And then say, okay, we are spending X crores on these 5 products. What could be the outcome out of these 5 products? Can 3 be commercialized? And what could be the business that's coming out of it? I think, and then what could be the margins? I think these are the questions we ask, and that will be decided based on that.
And just to be clear, Ajith, what you're saying is the questions you will ask as a promoter, but the executive management is in charge of running this entire process.
Absolutely.
Okay, very interesting. So I think, Shovan, you have your answer. What I think Ajit is saying is that the head of R&D, the head of product development should report to the CEO, to the executive management. The promoter, as the largest shareholder here, can ask questions about the capital allocation decision, how much should be invested in which product should be junked, which product should be expedited. And that's the demarcation and responsibilities.
I will just add one more point, Saurabh, is that I understand where the question is coming from. There could be always a conflict of interest, not conflict of interest, but there'll be a conflict in terms of understanding. For example, asset allocation for an R&D project, where the R&D manager and the CEO may have a difference of opinion as to whether to spend or not spend. All I'm saying is that the way we work is that we have regular meetings or reviews of these departments, whatever those departments are. And I think it is fair to say that in these departments, if there is going to be an allocation which the R&D manager is absolutely certain, there is nothing wrong in that general meeting. He should not bypass and come, but in the general meeting to raise, so that, look, I think this is a good product, whether we should be looking at it. Then it's the promoter's call, particularly in the smaller companies, to say, yes, I think it's a good project or not a good project. He may agree or disagree. That's fine.
Right. Fantastic. Now let's take the next leg of that. So one of the reasons, and this is the point to everybody who's listening, one of the reasons we thought we should invite Ajith Rai is he's an outstanding capital allocator. We do this for a living. We've met hundreds of promoters in India. We will find it very, very difficult to meet a promoter who allocates capital for acquisitions as smartly as the Suprajit board does. And a lot of credit for that goes to the way Ajith Rai and team think about capital allocation. So just leaving aside now R&D and organic business development, Ajith, what is it that you guys do that allows you to identify more often than most other promoters that we know in India, successful acquisitions. Right, Kongsberg was the recent example. The Westcon Power Cables business was an example. The halogen lights business was another example. You guys have a very good track record of buying businesses at relatively low valuations and then turning them into 21, 22, 23% ROC businesses. What is the recipe for Suprajit success?
First and foremost, I think we sort of decide where we want to invest. See, we are in automotive business, right? I mean, there is all kinds of businesses out there that are up for sale. I would say we probably get 10, teasers a month or whatever number of time. Probably we pick up one or two and ask for an IM. We don't even look at it beyond just a teaser in many times. The point that we make ourselves is that where we want to be in the automotive business. I think the idea is today at Suprajit is that we don't want to be in a segment of automotive business which is pricing is easily determined by the customer. I would give a specific example. Let's say a forge shop, a plastic molding shop, such areas where it is possible to weigh the component, say that, okay, this is the weight, this is the process charge, so you get your 6%, 8% margin. We don't even look at it. We are looking at a product. Today, whether it's a cable, we are a product. Whether it is halogen lamps, it is a product. Whether it is digital speedometer, it's a product. We are going into now, as Saurabh said, with the acquisition, we are getting into electromagnetic actuators. That's a new product. So all I'm trying to say that we look at products. We don't look at just a process industry to invest. Because when it's a product, and that too, if it becomes a proprietary part for a automotive, then the design, the entire costing is based on the importance of the product and also the competition. Another thing, see that who is my competitor in this business? Can I fight him? Can I do the product at a more competitive price than the competitors in this business? I think these are all multiple things that we look at it, but ultimately a product will have a price, a process will have a cost plus. So we avoid that most of the times.
Right. And that leads nicely to a question that Avanish Pandey is asking. He's asking, what is the barrier to entry in Suprajit products? So for a moment, so let's focus on the two-wheeler wiring business. And if we sort of take Avanish's question in the context of the two-wheeler wiring business, what is the barrier to entry? Why can't tomorrow morning Avanish Pandey raise some private equity or some venture capital and go to Hero Moto or HMSI and try to do two-wheeler wiring?
Oh, there is a long answer. I'll try to make it as short as possible. Let me ask a question back. I mean, we have a world number one or whatever number two fastener maker sitting in Chennai. I don't want to mention names.
Yeah.
Why are they number one? What is it so technologically impossible to do a nut and bolt? You get an imported machine from a Taiwan or a China, and you can make as good a nut as anybody else. Simple. Does it make you that you can break through their stronghold? What happens in most companies, that includes us, is that we create a moat around our customers who, over a period of time, don't think of a 1%, 2% price advantage. Today, of course, cost is very important. The price is very important. But over the period of time, the customers decide whether they can depend on a supplier or not. The dependency is not at all price. The dependency is your ability to develop, your ability to deliver, your ability to consistently give the quality, which they don't have to check. We have enough number of, you mentioned about cables, and there's enough cable competitors were there in India when I started. There's more number of cable guys when I first started business than there are today. Globally today, customer wants a supplier who can, supply them in multiple geographies, multiple platforms at just in time. That requires an ability which is proved over a time. Because today Suprajit has not, let's say, shut down a single plant. I can say that with the heart, my hands on my heart, ever. We have taken cables by an aeroplane to a plant, the cost of the aeroplane has cost me, I don't know, 100x than the cost of the cable, but that is the commitment that we have given to the customer. And that will never fail us in the long run. The customer tomorrow, if somebody else comes with 10% less, he first understands whether this guy has the capability to deliver. Today, beyond price, it is delivery, quality, and ability to develop in time. Again, that's very important too. So over a period of time, we create some kind of comfort with the customer. There's a famous hero, fill it and shut it and forget it on the bike. It is something like that. You have a supplier who is completely dependable. You just forget it. I mean, as long as, of course, if you start squeezing the customer on too much on price, they'll start getting concerned. But otherwise, if you're fair with them, I think, however, once you establish a customer relationship, barging into that relationship is not easy.
Okay, so because the subject matter of today was succession planning, we got lots of very interesting questions and comments on the subject. So I'll give you the comment and the question, Ajith. So the comment from Ankur Bansal is that, look, I'm myself a second generation entrepreneur. And if you put my father and me on the same video conference or in the same webinar, we will have diametrically opposing views. So I guess the comment therefore is, if your sons were on this call, maybe they'll have a different opinion on the subject, right? The question that then poses is, if fathers and sons or fathers and daughters, if two different generations take different views of the subject, and it's, a fair point, Ankur, it's been hard for us to recreate those conference calls where fathers and sons or fathers and second generations disagree. But to Ajith, the question is, if you get those disagreements within the promoter family between one generation and the next, then what is the modus operandi? What is the process for resolving those? And we're linking that to, for those who are listening, on the entrepreneurs and promoters who are listening, how would you suggest they then structure the succession planning so that the intergenerational debate? So we're diverging from the Ambani template here. In Ambani's, the challenge was the same generation didn't see eye to eye. But suppose here the generation T and T+1 don't see eye to eye. How can the promoter deal with that?
Yeah, I mean, I'm sure the famous generation gap exists anywhere. So probably, I'm sure it exists in my family as well. But the first thing that I try to focus or try to impress on, whether it is within the family or within the top management team, is to make it clear that it's what is important to the company, what is good for the company is also good for me. I think that's the first thing. You may have a disagreement as to how a particular, let's say, project is run, because the father may think that, you do it this way, whereas son is that, no, why I cannot do the other way. The reason being in many times that you are reporting to your father. So the father has done in his 30, 40 years certain things in a certain way, and is probably not willing to change it. I mean, we all develop some, whether we like it or not, certain way of doing things, which the next generation will not see as the right way or not necessarily the best way. The idea is to impress, this is good for the company. I think if your point of view is good for the company, and it is not about disagreeing with your father or mother, it's about what is good for the company. If you're able to discuss at that wavelength, not at a father and son, I do this, you did this way, you did this, no. By doing this, it is better for the company. Either I'm doing it earlier or with lesser cost or with the lesser people in this, whatever it is. If you're able to convince that, I think certainly I will agree if my son comes and tells me this. But in some places, there might be challenge on that, because as I said, the letting go is a problem for the first generation. The ego is an issue with the first generation. To some extent, I think it is good to, you can't help but have to manage it. But giving the larger picture of what is good for the company will probably resolve some of those issues. But that problem exists. I have spoken in other forums and it does exist. But, it's a part of learning process for youngsters. I think, a little bit of a longer period to understand it, I think.
And to be fair, if that problem didn't exist, you'd be worried, right? If this next generation...
Yeah, absolutely. If there is no disagreement, it's a problem.
Yeah.
Absolutely agree with that. I mean, there are many times we discuss and disagree, and in the end, we come to a conclusion that this is best. That disagreements have to be there.
Now, there's a whole bunch of questions on EVs. Before we get into those, I want to show people the Suprajit website. So folks, just for those who don't know, what does Suprajit make? Suprajit makes mechanical control cables. You can see I put them up on the website. They make instruments, speedometers, they make halogen lamps and so on. So now with that background, right, as to what this company makes, mechanical control cables for cars, motorbikes, EVs, speedometers, instrumentation, and the website is very good. At your leisure, you can see what the company makes. Now posing the question to you, Ajith, which is coming from several quarters, as to what will be the impact of EV as EV becomes more popular, right? Every week we hear about Ather or Okinawa or Hero Electric and so on and so forth. And this morning Maruti announced yesterday Maruti announced they were doing a big EV investment. As the EV industry accelerates in India, what impact does it have on your business, Ajith?
Yeah, EV is certainly there to stay. The question is how fast it will catch on is a question, depends upon the infrastructure. Globally, I would say EV is doing pretty well in Europe, to some extent in the US, particularly in the Western coast. Tesla is the big name, of course. And China as well is picking up on the EV space. I'll just step back a little bit on EV. We looked at EV becoming a reality probably 5-6 years ago, I would say. So what we have done, one of the things that we do at STC is the product development, which are need for EV and which are, will be able to get the interest of the EV manufacturing space. Just to give certain examples, for example, today, let's say the target is for Suprajit, let's say our content per, let's say, motorcycle is 150 or 200 rupees. What will be the content per, let's say, two-wheeler in 5 years' time, or 10 years' time? I think that's what I'm bringing back our long-term view. We look at today at Suprajit. So we have been working on products which are futuristic for the company. For example, one of the big successes that we have is in digital speedometer. Every one of the EVs are going for digital speedometers. We have had some, due to the last 2-3 years of work, we had some wonderful success in that. We are working on things like a thumb throttle, which is probably replacing one cable of ours. So that is being, in the final stages of approval with multiple customers. So what I'm trying to say that we have foreseen what could change. What's happening in the car segment is that we are actually seeing, it's not only EV, you should also look at, we are looking beyond EV to autonomous driving, for example. That would be the trend going forward. So we said that what is in its store for us in these kind of products? When you looked at automotive, we started realizing that there are, and in EV automotive as well as autonomous driving in the future, we started finding that even for our own hardcore cable, there are more applications that are needed. So, for example, in 5 years down the line, our own internal thing is that we will have larger content per car or larger content per motorcycle than what we have today. That's the way we have positioned our portfolio through our STC.
Okay, so just to be clear, you are saying EV is inevitable from the sounds of it. EV is inevitable, and you're positioning, Suprajit is positioning the product portfolio such that as EV gains traction, you guys get a bigger share of business.
And to add to that, Saurabh, I think, again, let's not say that EV will be there. We are producing whatever, 15, 20, 18 million two-wheelers, let us say. It will suddenly become 18 million, whatever number of million EVs in the next 2-3 years' time. It's a process. It's probably now 2-3-4% today. It will slowly gather. To give you a parallel example, when we acquired the halogen lamps business from the private equity, we said in 5 years, 30 to 40% would be LEDs. And we are now in 7th year. It is still not 30% in India. I'm talking about India. So, some of the times is also infrastructure, and I think there are a lot of challenges there. So yes, you will catch up, but will I say 100% it will change out EV? No, there will be other technologies that will come in. So there would be a significant part will be in EV in 10 years time. I wouldn't say that for a 5-year time, actually.
Fantastic. Now, lots of people are asking questions around, they're basically, I'll paraphrase, I'll join them up. So Laltendu Swen's question, Archit Maria's question. The question that they're asking is that there are lots of promoters, probably the majority of promoters out there, who haven't thought about succession planning, let alone having thought about succession planning as systematically as you have, Ajit. So if I am a promoter who hasn't thought about succession planning at all, right, and I need to prioritize, I need to think about what are the top 2 things or top 3 things to do, right? Since I haven't dedicated time and effort to it in the last 10, 20 years, and I now want to figure out succession planning, what would you say would be my number 1 and number 2 priority?
Good question. I'm happy that you asked that question. I mean, I was in the same dilemma, I suppose, about 10, 15 years ago. And let me tell you how I started. I think there is a Professor John Ward. He was with IMD, Switzerland, and then I think he went to the Booth School, Chicago, I think. He has written about 6 to 8, or I don't remember now, maybe 10 books. All small books, like a small diaries, not more than 100 pages, not like a full, coffee table book. It is a simple book, simply written, easy to read. It's on succession planning, family business, on anything regarding family constitution. You say anything about, he is like the guru of, family business, succession planning, and family business operations, to be frank. How to bring in professionals into the business. He has got a book on everything. He is a very well respected professor. He's retired now, I think. But those 6, 8 books would be the first starting point. They're easy to read. After a dinner, sit in the bed and read one book in every 2, 3 days. I think you'll get a basic funda on family constitution and what makes sense to you. I would say that is the starting point. And secondly, I think there are some good places where you should attend other families who are wanting to or trying to do this. One is, I think, CII has a family business, FBN. CII FBN has a good, I went to many of their conferences. That is very useful. I think Kavil Ramchandran at ISP has a family business department where they have a regular conferences. That's a good place to look for. I think these are the places to start, get an idea, and probably meet other families where they have a similar concerns and conflict as to how to do this. And when you attend, it's good to get the family together. Initially probably read the book, get an understanding, and then I think attend some of these things. I think they are a good starting point. Then I think you have to create your own journey and as to how you want to go about. I would say that would be the right way to do it.
Fantastic. So last question, Ajit. So Rishabh Malu is at the other end of the spectrum. He's joined his family's business. He's a second generation, I guess. Yeah, he's second generation. He's all of 22 years old. So bright career, I'm sure, in front of Rishabh. So what Rishabh is asking is that, look, I've joined this family business of ours, he's saying. Now I will be reporting to other family members, he says. How do I grow? So unlike, say, an Ashwin Shetty, who when he joined KPMG had a career development framework that a KPMG would put an Ashwin Shetty on, Rishabh Malu does not have that privilege. He will now work under his various relatives, I guess. So Rishabh is asking, how will he grow now that, given that he's only 22 years old, he has a bright career ahead? How does he make the most of his talent, Ajit?
The large family-run businesses where many family members are involved, you have to first internally see what is the hierarchy of progression. There is, I know well-run, for example, some certain South Indian families where there is a fairly good hierarchy as to how the next gen is groomed, elevated, progressed in the family, and whether they will, wherever they will reach, it is known. I think if there is such a progression within the family exists, it's good, so that you know what's your progress within the company. As long as there is a good family cohesion, if you're reporting, let's say you are 20 and whom you're reporting is at 40, there is a 20-year gap, whether you like it or not. Within the family, in certain families, these hierarchies are very important and they don't change the hierarchy. Then you have to be patient, because ultimately the other person who is 40, you are reporting, is also 20 when he joined the business. He has waited up to 40 to become whatever division head of whatever area that he has reached. Similarly, you will also take the same time to reach that position. Now, the point is that if you don't see that progress, that, okay, my boss currently is my uncle or my elder cousin who, if he is going to be the chairman till 80 or 85, then you have a problem. But if there is some kind of a clarity that, okay, at 60, 65 or 70, people change and the next gen takes over, your, I think, the route map to the top. Now, if this is not acceptable, then you have to find another way, because it is not necessary to me, at least in my family, I've made very clear, not necessary for them to join. As long as the business is run, they know what's in it for them, it's okay. So if that road looks not hazy, then you should pursue that road. Otherwise, you have to take a call, I guess.
Right. Now, thank you very much, Ajit. This was very useful. Folks, several of you are asking questions on the share price. To be honest, neither Ajit nor we know what's happened to the share price in the last 60 days. Neither do we know where the share price will be 60 days hence. And neither he as promoter nor we as part owners of the business are losing our head too much on the share price. The auto industry has its own cycle. Crude prices have their own cycle. Our goal has been to invest in businesses where the promoter's governance is strong, his capital allocation is good, and I say this with all seriousness, not just because Ajith Rai is sitting in front of us. The capital allocation has to be high quality, and the business has to have strong barriers to entry. Suprajit, to our mind, meets all three criteria. You look at the 5-year, the 10-year, both the compounding of free cash flows by this business, which to our mind is without peer in the auto and also ancillary industry. We haven't found any other auto anch or auto OEM in India which has compounded free cash flows in the low 20s in the way Suprajit has, and a big driver of that has been stellar capital allocation alongside building of long-standing competitive advantages, which is why the company continues to be a holding in several of our portfolios. But as I said half an hour back, don't let us be the guide there. If do your own research if you're thinking of buying the shares. Thank you very much, Ajith Rai. Thank you very much for being a source of wisdom.
Thank you, Saurabh, and the entire team. I wish you all the best, and I'm sure your investors will benefit by your investment capabilities. All the best.
Thank you.
Thank you very much. I'll probably listen into the balance, but I will go off the video if you don't mind.
Thank you, Ajit. Thank you very much for your time.
Thank you. Thanks a lot, everybody, for the opportunity to talk to you. Thank you.
Our pleasure, sir. So, Ashwin, over to you to give our clients a overview of how Little Champs has been performing. Before we get into that, as several of you know, we've opened Little Champs for a little while for inflows. I think after 2.5 years, we've opened Little Champs for a small window of time. Some of you are asking, should you or should you not invest? As we have said consistently, Little Champs should be a small part of your overall equity allocation. So CCP is the bread and butter. That's the main course, the dal chawal. Portfolios like Rising Giants and Kings of Capital is the sabji or the paneer, the kind of protein dish in your meal. And Little Champs is the dessert. Its returns have been stellar. Ashwin will discuss the returns in a bit. But Little Champs, even though the returns have been stellar, is illiquid. And since there are exit loads and so on, my submission to you would be Little Champs should not be more than 20% of your portfolio. So to the extent SEBI's minimum is 50 lakhs, if you have a 2.5 crore corpus, of which you can consider putting 50 out of 2.5 crores, you can consider putting 50 lakhs in Little Champs. If you have a 5 crore portfolio, you can consider putting 1 crore in Little Champs, but don't let small cap portfolios like Little Champs, however high quality they might be, I wouldn't suggest you make it more than 20% of your portfolio. So with that, I'll hand over to Ashwin to discuss Little Champs performance.
Thanks, Saurabh. Let me share the presentation. So yes, it's a tough act to follow. I'll keep the update a bit brief, next 10 minutes. So first of all, starting with the portfolio fundamentals. So we are very happy with how the overall fundamentals for the portfolio companies have shaped up through the COVID. So as you can see, just to recollect, the FY 16 to 20 growth rates, earnings growth rate, free cash flow growth rate compounding for the Little Champs portfolio at the weighted average level have been in the vicinity of 20%, despite a very adverse macro environment. So that compounding has only seen acceleration in the last 18 months or so. So if you can look at the 9 months column, the red circle at the bottom, you'll find that the revenue growth has really accelerated in the last 3 quarters. And similarly, the PBT growth also, particularly at the weighted average level, there is a growth of 24% for the last 9 months. So the causes for this is exactly what we highlighted during the height of the COVID in 2 years back, that in fact, while it is a near-term crisis, but structurally it plays to the advantages of well-run, strong balance sheet companies. So it has played that playbook. So primarily, most of these companies have benefited from acceleration in the market shares, thanks to their strong balance sheet, thanks to their very high return on capital employed. Where at the same time that peers, they don't have the balance sheet in place. They operate on very wafer thin margin. They operate on very little return on capital employed. So clearly, the crisis has led to an acceleration in the market share gain for most of the portfolio companies. And I think that is been a key driver of the acceleration in the earnings growth that we are seeing in the screen in front of us. And we believe that only a part of that the market share gain story has played out. So as you can see in the screen of front of you, so most of the companies, portfolio companies, have really actually pressed on the accelerator. You'll find that whatever has happened in the last 18 months in terms of setting up, both in terms of organic expansion as well as in terms of the inorganic expansion, we have not seen such kind of strong capital allocation, accelerated expansions, both organic and inorganically, in such a short span of time. So while some of these measures have benefited and helped the revenue and the earnings growth in the last 18 months, but we think much of this has actually yet to play out. For example, if you look at all the companies for that matter, GMM, I think the acquisition of the parent really, it has played a very small part in the last 6 months or 12 months, but much of the benefit will actually flow through in the coming years. Similarly, alkyl amines, new acetonitrile plant, new expansions, they will really actually, come very strongly in the years to come. And similarly, Suprajit, for example, the recent Kongsberg application, the light duty cable business, it actually really is not factored in the recent quarter's earnings, but it will really flow through in the years to come. So basically, in other words, we think that whatever the growth that we have seen in the last 15 months, in the last 18 months, we are very, very confident that thanks to the market share gains, thanks to the capital allocation initiatives of these companies, that will continue. And in fact, it can continue at an accelerated pace in the years to come, next 3 to 5 years. So we are very sanguine about the prospect. Near-term quarterly notwithstanding, we are very, very sanguine about the prospect, earnings growth prospect of our portfolio companies in the next 3 to 5 years. And coming to the very pertinent near-term question about the impact of the input price inflation. So honestly speaking, we don't know where the crude will head, what will be the quarterly impact on the earnings. But what gives us confidence from a medium to long-term perspective is the history of these companies in terms of maintaining their margins. For example, in the table below, what we have done is for the last 10 years, we have mapped how many times the companies have seen a deceleration in the gross profit. We think that instead of looking at the revenue or the margins, because margins get optically impacted because of the pass-through. So it is looking at the change in the absolute gross profit is a better measure of evaluating or judging the pricing power of the companies. And you'll find that even when we take a very small time period as 1 quarter, we'll find that last 10 years only 18% of the time the portfolio companies have seen a deceleration in YOY quarterly gross profit, absolute gross profits. So in other words, more than 80% of the times, and again, even after looking at only a narrow period like a quarter, more than 80% of the times, the companies have reported positive change in the gross profit. So that actually kind of is a testimony of the pricing power of these companies. And if you expand the period to 4 quarters, rolling 4 quarters, you'll find that more than 90% of the time, that is the last column over here, more than 90% of the time, these companies have seen a positive YOY change in the absolute gross profit levels. In fact, if you actually, we remove the 2 COVID affected quarters, which were March 2020 and June 2020, where literally there were no operations which were going on, this ratio will be even less than, basically it will cross 95% actually. So this simple statistics in front of you, actually, it gives us a lot of confidence about the pricing power of these companies. And anecdotally speaking, also, we have been highlighting in our webinars, in our newsletters, most of the portfolio companies, they command dominant market share. For example, the company which we talked about, Suprajit, it has more than 60% market share in the domestic cable business. So by virtue of their dominant market share also, they command a very high degree of pricing power in the industry. In other words, there is nobody to replace them actually, right? So the OEMs or the B2B business or the customers, they don't have any alternative but to take products from these companies. And also, most of the companies that we own, they, in terms of their contribution to the end, in terms of the contribution to the overall end product cost, it is very minimal. For example, GMM Fowler, the glass-lining equipment cost in the overall capex for a pharma or a agrochemical company, it will be less than 5%. So that also actually gives them a buffer. So even if you raise the price by 20% for the customer, end product mein uska impact itna nahi aayega basically, right? So that also kind of plays to our advantage. And also what plays to our advantage is that most of the companies which we own, they are present in resilient end user industries. For example, most of the first initial names which you see, they are either into pharma companies, supply to the pharma industry, or they supply to the food industry or personal care industry, where typically the demand is relatively inelastic to the prices, because these are all necessities of the life. So customers, unfortunately or fortunately, they don't have any choice but to kind of buy these products even by paying the higher prices. So I think I would say almost 50-55% of the portfolio, they cater to resilient end user industries. So that also helps. And finally, I think also, I think as I said, like these companies, they command dominant market share. Even if they voluntarily choose to absorb higher price hikes, it will actually help them in terms of long-term market share, because the competitors, as I said, like they operate on wafer thin margins. They really don't have free cash flow. Their balance sheet is really out of shape. So if these companies actually choose to absorb price hikes for next 2 quarters, 3 quarters, actually it will put the peers out of the business. So while it will impact the quarterly near-term margins, but in terms of structurally, in terms of consolidating the market share, gaining market share, it actually, this crisis actually puts them into an advantageous position from a medium to long-term perspective. So in other words, summary, there will be some near-term impact on margins of this company. Third quarter may be tha, fourth quarter may ho sakta hai. But when you look from a medium to long-term perspective, given the track record of these companies, given the dominance of these companies, given the kind of competition these companies face, we actually are not so bothered from a medium to long-term perspective of this, the input price inflation on this company's profitability. And finally, coming to the return side, so this is how the returns look. So from really from a 1 year perspective or 2 year perspective, you'll find that there is a bit of underperformance. But when we put things into the context, I think that explains the underperformance. One is that last 2 years, 1 year has been really a bull market ride, and as we have explained in our previous webinars, in our newsletters, our portfolio is not meant for the bull market. Actually, they will give a very good absolute return in the bull market, but our portfolios are really not meant for outperforming in the bull market, because bull market may typically the stocks. What kind of stocks outperform? Those are the stocks which have fallen the most in the bear market, right? So they will rise the higher from a low base. And that is what we have seen in the broader small cap market. The stocks which had given the best returns in the last 2 years, 1 year of the bull market, those stocks actually fell the highest during the COVID crisis. And that is also.
Ashwin, do we have some of those names? We might as well show those to the audience, right? Yeah, so that they can see.
So for example, in this slide, we have collated the best performing stocks in the BSE small cap. That is on the right hand side exhibit. You can actually make out from the names, these stocks would have fallen the highest. For example, most of them are into commodities, most of them are into infrastructure companies, real estate, etc. This company really got rogered, in the Jan to March 2020 quarter during the first COVID crisis. So when you have fallen like 60, 70, 80%, so obviously, in the bull market, you will rise. But the problem is when you look at the complete picture, not just focus your attention on last 1 year, 2 year of the bull market, but when you take a little bit longer time period, which encompasses various cycles, then you will find that, these stocks are actually not generated very significant absolute return when you look at a longer time period. Say even 3 years for that matter. Last 3 year ko dekho, you'll find that in terms of absolute return, last 1 year, 2 year mein acha dikhega, but 3 year perspective, so these companies who don't have delivered great returns.
Ashwin, I think, has been very polite. So folks, the list on the right hand side, some of them are seriously naughty companies. I think if Ashwin and I were reborn 3 times over, we wouldn't go anywhere near them. Some of them are pure commodity companies. So as Ashwin is saying, we are not here to invest in names like the stocks on the right. Anybody wants to invest in the stocks on the right, please, I'm sure there are other very smart PMS fund managers in India who will do it for you, but we have no interest. We are very happy with the portfolio on the left because the portfolio on the left meets the 3 classical Marcellus criteria: clean promoters, clean accounting, good capital allocation, and dominant franchises. So every time you show us left versus right, we will go for left. And I'm sure the people who come on daytime TV and so on, many of them invest in the stocks on the right. And they are welcome to do so. We'll have no interest. So just go back to the track record, Ashwin. Right. So the Marcellus client will ask upon seeing this track record that, what's the point? Why should I invest in a product like this which underperforms? Abhi to bull market chalu hai. I want to outperform in a bull market. What is our response to that, to those who want to outperform in a bull market?
Sorry, Saurabh, can you repeat the question?
Yeah, so I think a lot of people who will be listening, and I'm sure a lot of the people who are listening are reasonably representative of the public at large. They'll say, boss, I want to outperform in a bull market. I'm a alpha male, I'm an alpha female. Mere ko to alpha chahiye rahega. So I want to outperform in a bull market. And our view is we are not interested in outperforming in a bull market. So why should anybody invest with us in Little Champs? And indeed, why should anybody invest with Marcellus in any of our portfolios, since we are not interested in outperforming in a bull market?
I think the question is, if you are very confident that bull market will last forever, I think you don't need to invest in Marcellus. But the problem is that you look at the BSE small cap index itself for the last 10 years, you will find that there are so many ups and downs. And whatever is gained in the up cycle, it is more than lost in the down cycle. So last 10 saal ka hi dekh lo, you'll find that I'm pretty confident that at least there will be 4 to 5 instances where, basically there is a sharp deceleration or drawdown which has happened. So that is the nature of the market, and more so of the small caps, right? So there is cycles which happen. So our portfolio is built not keeping the bull market cycle in mind. It is kept in mind that there will also be down cycles which will follow the bull cycle. So, that is how our portfolio is built. But if one is assuming that bull market will last forever, I think maybe we should look at different alternatives.
So let's take some questions. So Ashwin, I'll deal with some housekeeping questions, and then we'll come to VMart. So the question on VMart that you might want to field in a couple of minutes is, is there any risk to VMart because of Amazon, Flipkart, the rollout of Amazon and Flipkart into small town India? If you could take that. So whilst you think about that, quick housekeeping questions. So some of you are asking 3-year lockup in LCP. No, LCP does not have a 3-year lockup. PMS may, SEBI will not allow us to do a lockup. What we have, and we've always had in LCP, is a exit load. So there's an exit load in LCP. We've always had it before. We have it now. We put it in place to deter people who want to do short-term punting in small caps. If you want to do short-term punting in small caps, please don't come to LCP. It's not meant for that. And hence, to deter you from investing in LCP, we have put an exit load on LCP. There is no lockup neither on our PMS products nor on any other PMS product in the country. It's not allowed by SEBI. Yes, this webinar will be put on our website. Some of you are asking for it. It will be put on our website. Some of you are asking for the name of the author that Ajith Rai ji mentioned. The name of the author is John Ward. And Ashwin, if you just stop the screen share, I'll beam up John Ward's website, because I found it whilst he was speaking. So John Ward has a lovely website. He runs a business called, here's John Ward's website. It's called the FBCG, the Family Business Consulting Group, yeah, FBCG. So Ajith Rai ji was mentioning that he's learned a lot from John Ward's books. So his books are mentioned here as well. John Ward's books are mentioned here. Perpetuating the family business as paradox, keeping the family business healthy, and so on. So Ajith Rai ji recommended them. It's called the Family Business Leadership Series. So we too will also go through this because it looks like a fabulous website. So now coming back to you, Ashwin, on VMart. And folks, if you want, fire away other questions to Ashwin in the Q&A box. We have him till 6:30. Go on, Ashwin, on VMart.
So VMart, we don't see much impact of the online or Amazon or Flipkart for that matter. So primarily because of two things. One is that VMart operates in tier 3, tier 4 cities, where typically one is that internet access is lower. Typically, also VMart operates primarily into low ticket size items. So I think average ticket size of an apparel sold by VMart is close to I think under 200 rupees or 250 rupees. So where we see relative kind of threat of online threat actually is minimal actually. At the same time, VMart is also working on its improving its online aspects. So already I think around 4 to 5% of its revenue come from the online channels. So the company is at the same time also working on the improving its online traction.
So folks, here, what's happened to a lot of us is because most people on this call are relatively affluent and they are high digital users, they think the rest of the country is also affluent. They think the rest of the country is also gone digital. The typical Indian earns 2 lakhs a year. The typical Indian earns 2 lakhs a year. For a typical Indian, buying a garment more than 200 rupees is a big deal, right? The VMart does not cater to you and me. VMart caters to that 70-80% of India which earns 2 lakhs or less, which needs to buy garments of 200 rupees or less. No digital platform in the country caters to people who earn as little as 2 lakhs a year and buy garments of 200 rupees or less. So that's the opportunity VMart is focusing on. All the people on this call, you, I, us, we are more like Trent, West Side, that sort of crowd, which is not bad. Trent, there's a client base for that sort of product as well. VMart is not focused on people like you and me, and neither is Flipkart and Amazon a real threat to people like VMart. Just go to the VMart website, look at the sorts of places their shops are located in, and you'll be able to understand we're not even talking tier 2 India, we're talking tier 4 India, places where the footprint of digital is modest. Next question again. Okay, there's some people who want to know, do we have a sales officer in Delhi? We do, but the best thing for you is just write to the omnibus email address, sales@marcellus.in, and somebody from our sales team will reach out. Whether they are in Delhi or Bombay is secondary. But by all means, if you want someone based in Delhi to reach out, just write to sales@marcellus.in. Say that you want someone from Delhi to reach out, and one of our Delhi-based colleagues will reach out. Ashwin, over to you on alkyl. Apparently, Deepak Garbji believes that you have reduced alkyl in CCP. Please share rationale, says Deepak Garbji.
Yeah. So basically, there is no change in our long-term earnings growth projection or the score for the alkyl. The only change is that we earlier we exited from few stocks which were low liquidity names, and the stocks which we have entered, which actually we display in our slides, so they have higher liquidity. So earlier, because these companies had lower liquidity, we had to actually bypass our algo to some extent and put a little bit higher weightage in a high liquid stock like alkyl amines. But now that we have got new stocks which have relatively good liquidity, we have aligned the alkyl weightage to what is warranted by our algo. So there is no change in our fundamental view of alkyl. There is no change in our earnings growth projection, free cash flow projection, or any longevity score. It is only that we have got stocks now which have relatively good liquidity, and hence we have reverted alkyl's allocation to what is warranted by our algo, our position sizing algo.
Okay. Question on Moltec packaging. with the recent resurgence in COVID cases, with higher inflationary pressures to come, how will Moltech packaging cope with this negative impact? I guess Anonymous is asking Ashwin, Moltech packaging अपना margin को कैसे protect करेगा? And what do you make of the recent announcements of foraying into newer segments and exploring US markets?
Yeah. So I think first question was on the COVID side. So I think again, Moltech is something which kind of caters to relatively resilient segments. For example, a big chunk of Moltech's revenues come from food and FMCG segments. Where we have seen them even during the peak of the COVID. I think their revenue, Moltech performed relatively better on revenue growth, etc., compared to other stocks in the portfolio, thanks to their significant exposure to food and FMCG segment. And secondly, again, Moltech commands one of the best pricing power. So you can look at the company's profitability itself over the last 3 to 4 quarters. In fact, even in third quarter, where some of the other portfolio companies did saw some deterioration in margins, Moltech's per kg EBITDA, actually it was relatively resilient. And if I am not wrong, actually it was positive year on year. So again, thanks to because Moltech is into value-added products like IML, in-mold label, where there is really no competition, right? So the customer doesn't have any choice but to give the higher hike to Moltech. So I think the per kg trend of Moltech in the last 3 quarters, where we have seen enormous increase in the crude oil, that itself actually gives us a lot of confidence. And thirdly, obviously, they are actually building on to their in-mold capability. They are entering into, for example, paints में Hitarto, the predominant packaging style has been HTL, heat transfer label. Now that Moltech has got very good success in food and FMCG, they are also pushing through IML in the paints category. They come up with some innovative initiatives like QR code, which actually cuts down significantly on spurious, kind of containers, etc., in the paint segment. So they are building on their in-mold capability, and if the doors of paint and lubricant industry opens up for IML, I think this will be a very big opportunity. So incrementally, they are not putting much capital. There is no big capital which is being employed. It is rather basically building on your existing capabilities and trying to make the customer aware of the benefits that this in-mold technology has.
Okay. Kailash Madan is asking about how India Mart and V-Mart compares. Madan Saab, there is no comparison. India Mart is an online classifieds business. V-Mart sells clothes. It's completely different. The only superficial similarity is the letters MART are in the name of both companies, but India Mart and V-Mart are in completely different businesses. And last question, Ashwin, we will take is, some people, Anonymous is complaining, why do you share your portfolio, Ashwin, on the open forum? How fair is it to the LCP clients that aapne portfolio de diya? What do you have to say about that, Ashwin?
Yeah, I think it is. I think we obviously share the portfolio names. I think we like to be as transparent as possible. But the one thing which we don't share is basically the allocation to the individual stocks. I think where we are kind of maintained some sort of secrecy. But I think that is what we have followed from day one at Marcellus. I think we have been kind of very transparent in sharing the portfolio names.
So folks, easy way for you to think about it. You download the Berkshire Hathaway annual report. You'll know everything Warren Buffett has been investing in. You can download the Berkshire Hathaway annual report going back, I think, to 1972 on their website. So for 50 years, Warren Buffett has told the world every year what he owns, what he's bought, what he's sold. In spite of Warren Buffett having told the world for 50 years what he owns, what he's bought, what he's sold, even then there is only one Warren Buffett, right? So why is that the case? Warren Buffett has made it transparently clear what he owns, what he buys, what he sells. Why is there only one Warren Buffett? Because knowing the portfolio of Warren Buffett, knowing the Little Champs portfolio, knowing the Consistent Compounders portfolio, knowing the Rising Giants portfolio, or indeed any of our portfolios, right, does not mean you can go and do what we do. because there's a certain training, there's a certain skill set, a mindset that an Ashwin Shetty has developed over the best part of 15 years of training. Just like I can watch Virat Kohli on TV for the next 5 years, 10 years, and still not be able to play anything like Virat Kohli. You and I can watch Ashwin Shetty's portfolios, or indeed any of our other fund managers' portfolios, and still not be able to invest like them, because the mindset, the mental skill set, whether it's a Warren Buffett or a Virat Kohli, is irreplicable. And that's why investors buy Berkshire Hathaway shares, and that's why we all pay good money to watch Virat Kohli bat. So thank you very much for your time today. Thank you for listening to Ajith Rai Saab's insights and Ashwin Shetty's insights, and have a good evening. Thank you very much.
Thank you. Thank you, everybody. Thank you.
Bye.